Right now, American offices are the emptiest they have been since 1992. Almost 1 in 5 sits vacant. In downtown San Francisco, it's more than 1 in 3. And last year, a 16-story tower there sold for $6.5 million, after selling for $62 million just 6 years earlier. A 90% collapse. So here's the part that stops you. On the bank's own books, almost none of these loans are in trouble. The delinquency rate on commercial real estate loans is 1.56%, near the lowest it has ever been. Buildings crashing, loans pristine. That contradiction is the whole business. First, let's be sure the emptiness is real, because it is staggering. Nationally, office vacancy hit 19% in 2024, the highest since the savings and loan bust of the early 1990s. But the national number hides the extremes. In downtown San Francisco, Class A vacancy reached 36.8%, up from around 4% before the pandemic. Oakland and San Jose set their own records above 31%. And even the buildings that are technically leased are half empty in practice. Badge swipe data shows offices running at just 56% of their pre-pandemic occupancy. The desks exist. The people mostly don't. And when a building actually trades, the numbers are brutal. Take 995 Market Street in San Francisco, a 16-story office tower. In 2018, it sold for $62 million. 5 years later, the owner defaulted. And in 2024, it went to auction for $6.5 million. That is a 90% discount. The buyer paid about 10 cents on the dollar. It is not a one-off. In Chicago, a 57-story loop tower bought for $375 million in 2014 went under contract a decade later for around $100 million, a 73% markdown. These are not distressed corners. These are the trophy addresses. So the buildings are worth a fraction of what they were. Now, put that next to what the banking system reports, and the strangeness sharpens. This is the delinquency rate on commercial real estate loans held by American banks. In the 2008 crisis, it climbed above 8%. Today, in the middle of the worst office slump in a generation, it sits at 1.56%, barely off the record low it touched in 2019. Think about that. Offices are emptier than they have been in 30 years. Towers are selling at 90% discounts, and the loans behind them are officially almost perfectly healthy. Someone is not marking reality. The rest of this video is how. The first trick is how the buildings are valued. Most commercial property is not priced by what it would actually sell for today. It's priced by an appraisal, a model. And appraisals are deliberately smooth. Studies of decades of real sales find appraisal values lag the true market by 12% or more, and they only catch up slowly. You can see it in the official price index. From its 2021 peak, the broad commercial real estate index is down only about 10%, while individual office towers change hands at 70 to 90% off. How? Because the index blends offices with warehouses and shopping centers that held up. Average the disaster with the survivors, and the disaster disappears. On paper, at least. The second trick is who holds the loan. When an office loan comes due and the building is worth less than the debt, the bank has two choices: force a sale and book the loss today, or quietly extend the loan and pretend it's fine. Overwhelmingly, they extend. It even has a nickname on Wall Street: extend and pretend. And the scale is enormous. Roughly $875 billion in commercial mortgages come due in 2026 alone, a maturity wall the New York Fed sizes at around 27% of the entire banking system's capital. Now, Fed researchers actually argue about this. Some say the extensions are disciplined risk management, not pure denial. But either way, the law stays off the books. The clock just keeps getting pushed forward. The third trick is the tax code. When you own a commercial building, the government lets you pretend it is slowly wearing out, depreciating at over 39 years, and deduct that decline from your taxable income. Here's the strange part. You get that deduction whether the building is full or empty, rising in value or falling. So an owner can collect no rent, watch the tower sit dark, and still generate a fat paper loss that shelters income from completely unrelated businesses. The vacancy that looks like failure to a tenant looks like a deduction to the tax return. Empty isn't neutral. Empty is a write-off. There is one player in this machine that does not get to pretend: the city. Property taxes fund the schools, the buses, the police. But assessments don't fall automatically when a building empties out. The owner has to file an appeal to get taxed less. And they're filing in droves. In San Francisco, tax appeals jumped from around 1,400 before the pandemic to 9,000. The result: over $100 million a year in lost property tax revenue, and a hole that widens every year the towers stay dark. The owner shelters income. The bank extends the loan, and the city quietly picks up the tab. Now, there's a second kind of empty tower, and it's the mirror image of everything we just saw. Walk down Billionaires Row in Manhattan, and you'll find super tall luxury towers where nearly half the units sit dark. But these aren't empty because no one wants them. They're empty on purpose. Across those towers, non-resident buyers now make up around 3/4 of the biggest sales. For a Saudi investor or a hedge fund billionaire, a $50 million apartment they never sleep in isn't a home. It's a safe deposit box that happens to have a view. Down in the office district, the building is empty because it failed. Up on Billionaires Row, the building is empty because it succeeded. Same darkness, opposite reason. If all of this feels unprecedented, it isn't. Rewind to the 1980s. Deregulated lenders poured money into commercial towers, overbuilt wildly, and by 1992, major market office vacancy hit almost 19%, nearly quadruple where it started the decade. Then the loans that have been extended and pretended finally came due. More than 1,000 savings and loans failed. The cleanup cost taxpayers and the industry around $153 billion. The vacancy record we just broke? That was the record we set last time the same machine ran too long. Empty towers don't stay quietly empty forever. Eventually, someone has to mark reality. So how does a building make money with no tenants? It stops being a building. To a tenant, an office is a flow. You pay rent, you get space month after month. But to the owner and the lender, the tower is a stock, a pile of value that can be appraised high, borrowed against, depreciated for taxes, and simply held while everyone agrees not to look too closely. The rent is almost beside the point. An empty skyscraper isn't a failed business. It's a financial instrument that happens to be shaped like a building, and it keeps paying its owner long after the last tenant turns off the lights. So next time you walk past a dark tower and wonder how it survives, remember, for the tenant, empty is failure. But for the owner, the bank, and the tax return, empty is just another way to make money, right up until the loans come due. The building isn't broken. The market is working exactly as it was designed to, for everyone except the people who thought an office was for working in. If you want the sources behind every number in this video, they're linked in the description. Subscribe, because next time we're going somewhere the pretending already ran out. Argentina, a country that has defaulted on its debt 9 separate times, and a machine that keeps breaking it.